All right. Thanks those of you that are on the call tonight. My name is Brian Davis with AccuPlan Benefit Services, and we're going to be joined in a minute by Jillian Hellman, who is the CEO and co-founder of Realty Mogul. She is she's a specialist in wealth management, finance, and risk management, and a certified wealth strategist. And I'll let her come on in about 15 minutes or so to give her a further introduction to herself and her company, Realty Mogul, and tell us about our topic of tonight of crowdfunding for real estate in your IRA. For those of you on the call, you are muted. There is a chat box that should be on your screen that you should be able to ask any questions of any of the presenters tonight, whether it be myself or Jillian. And if anybody has any questions, please don't hesitate to chat in there, or we'll have time for question and answers after the presentation. We should be out of here by 7 o'clock. So just in the sake of time here, I'm going to get going. So thank you guys for showing up tonight, taking time out of your evening to listen to us here. And again, if you have any questions, please feel free to put them in the chat box, and we'll get those answers for you. So I'm Brian Davis with AccuPlan, as I said. A little disclaimer before we get fully going. AccuPlan, we are a self-directed IRA custodian and administrator. We are not financial advisors, so we can't endorse any products nor provide any investment advice because we don't have those specialties. Everything here is for educational purposes only, so please consult with your financial professionals, attorneys, accountants, and others before entering into any type of investment. So now that I got the legalese out of the way, a little bit about myself. Again, Brian Davis with AccuPlan. I've been in the self-directed IRA space for over 4 years. Prior to that, I was in real estate for about 6 years and in insurance and annuities for a couple years. I've been with AccuPlan for over a year, as they are one of the largest providers of self-directed IRAs and 401ks administration services. So we help people take their retirement funds and invest in the alternative asset space, a lot of that being real estate and notes, and I'm really looking forward to hearing about Realty Mogul in a little bit here. So for those of you that don't know about self-directed IRAs, you're not alone. A lot of attorneys and accountants are really unaware of this little niche, as well as financial planners who specialize in securities, stocks, bonds, mutual funds. But there's a whole lot of things you can do with your retirement funds besides the stock market. Just a little background, there's over $4.7 trillion in just IRA assets at the end of year 2010. That doesn't even include 401ks and other defined benefit type plans. The majority of those funds are in traditional investments with, stockbrokers, so in mutual funds and insurance annuities and, stocks and bonds, those types of things. So only 2% at that time was truly in an alternative investment, like a non-securitized asset, like a private placement or real estate. That number is starting to grow. When Mitt Romney came out just over a year ago with his financials that he has somewhere between $25 and $100 million self-directed IRA, it brought up a lot of attention to what we're doing here in this space, and it's a growing niche industry. So a lot of people that want to take control of their IRAs and invest in other investments can do so. What we're seeing at AccuPlan is people investing mostly in real estate, private businesses, using their money as a note or loan, and even some precious metals. I'm not typically seeing the precious metals buyers here in San Diego, but some of our other reps across the country are seeing a lot of their business come from that. I'm mostly dealing with real estate, notes, and private businesses. There's a huge list of different types of investments: trust deeds and mortgages, tax liens, limited liability companies, offshore land, raw land. The list goes on and on and on. The IRS has actually never put a list of acceptable investments, just what you cannot invest in. And there's really only 2 things that an IRA can't invest in, and that is life insurance contracts and what the IRS deems as a collectible. And as you see from this slide here, these are some examples of what the IRS deems as a collectible: a work of art, a rug collection, metal or gem. There's even some exceptions to this with precious metals. So really, you're wide open. The other thing is your IRA is not allowed to be a member of an S Corp, but that's an S Corp rule, not an IRA rule. So that's something to think about as well. There are, however, these things called prohibited transactions. Besides those investments that you can't make, as we just discussed before, your IRA can't get involved with who's considered a disqualified person. If your IRA does get involved with one of those disqualified people, it's said that that transaction is prohibited, and there's some severe penalties for that transaction. So who's a prohibited transaction? Who's a disqualified person? This can be looked up if you wanted to Google IRC 4975. That's Internal Revenue Code 4975, and that's where all of the rules come by of who's a disqualified person and what's a prohibited transaction. But the main points you want to think here are family members. And family members, not all family members either. Family members in a straight line up and down to you. So besides yourself or your spouse, you got to think about your parents, your grandparents, kids, and their spouses and grandkids. So that straight line up and down is kind of a no-no. Anyone that's providing services to the plan or a company in which you or one of those other disqualified persons owns directly or indirectly a majority of. And again, people, if you have questions about this, please feel free to write them in the chat box, and we'll get to them as we can. So what happens if you do get involved in a prohibited transaction? Well, you don't want to get involved in that. So it's a point that we'd like to go over a lot here. If the IRS goes back and sees that there was some type of prohibited transaction in your IRA, they can go back and disqualify your IRA as of January 1st of the year that the prohibited transaction took place. So if they went back and audited your records and saw that maybe you had a property that you owned and you paid your son to paint the place, that could disqualify that whole IRA, and they could go back and retroactively tax you on that if it was in some type of pre-tax IRA, and the tax consequences could be big depending on when it was done and how big your IRA is. So you don't want to get involved in that. So I'll go over this a little bit more in detail here. Everybody probably remembers the game of Deal or No Deal. This doesn't work as well, obviously, in a webinar format where everybody's muted, but I'll go through the steps here with you guys anyway. So could your IRA lend you, yourself, $10,000? Deal or no deal? The answer to that would be no deal. You are a disqualified person from your IRA, so you can't have any interaction with your retirement plan. What about your brother? $10,000. Can my IRA lend my brother $10,000? Deal or no deal? The answer to that one's deal. He doesn't fall in that straight line up and down category. He's on the side. So the IRS, in their infinite wisdom, has said that is somebody that your IRA can transact with. We'll get a little tricky for you here. What about your stepson? $10,000 loan. Deal or no deal? This one's deal, and only because it's stepson. If it was your son, it would be no deal. But stepson, they've said, hey, that is not a direct descendant, and so that one works. What about daughter-in-law? $10,000. Deal or no deal? That one's no deal for children and their spouses. So they count your children and their spouses, but your stepkids doesn't, it's okay. So it can get a little bit tricky, and that's what I'm here for, to help guide people through the process when they're going through a transaction, of helping them go through, oh, what can I do or not do? And sometimes, you know, I can help show you the Internal Revenue Code and go with it from there. So that's kind of the role that I like to take place. How do I get money into my self-directed IRA? Well, it's pretty simple. Self-directed is really just a marketing term. We work just like any other retirement plan. We have traditional IRAs, Roths, SEPs, Simples, and even the solo 401k. So if you had money in another IRA, we could do what's called a trustee-to-trustee transfer, move your funds over to your IRA with us from whatever IRA they were in, and then you can direct us to invest in real estate or the investment of your choice. You know, you're not limited to what the brokerage houses offer you. If you're in an employer plan, like a qualified plan, a 401k, 403b type plan, you want to request a direct rollover to your IRA with us. So in that case, you open up the IRA, contact the administrator of your former plan and move it over. Common question I get asked here, Brian, what about my current 401k? Can I bring those funds over to self-direct? The answer to that is maybe. You need to talk to your plan administrator to see if they allow what's called an in-service rollover. So what that means is the plan actually allows you to move funds to an IRA while you're still in service. I would say this isn't a minority. Out of the clients or prospective clients, I should say, that ask me, can I move my current 401k over? It seems about a quarter to a third of them have been allowed to move it, and it's generally whatever the vested amount is, and there's sometimes a cap on a percentage they can bring over. So it's something that could be available to you. You would, if you're interested in that, you would just need to talk to your plan administrator. So, or you can make your annual contribution. Well, if you're like most folks, you're looking generally at the traditional or Roth IRA, which are limited at contributions of $5,500 a year. If you're over the age of 50, you can throw in another $1,000. If you're somebody that's maybe self-employed or your employer offers a SEP IRA, this is where you can contribute up to 25% of your income with a cap at $50,500. So a lot of self-employed folks utilize this. It works just like a traditional IRA, except that the contribution limits are different. So it's for the self-employed individual. Another plan is it's called a simple IRA, and I don't see these all too often, but it's similar to a 401k, but it falls under the IRA guidelines, not 401k guidelines, and allows people to contribute to their plan, and their employer can match a little bit as well. I rarely see that plan, but we do offer it. The other plan that we're going to touch on here is an individual K, or a solo 401k. You hear it, or an individual K. This plan works just like a company 401k, but it's strictly for those individuals that are self-employed with no employees, so no W-2 employees, I should say. And it's a lot easier to contribute the $50,500, as it shows here, to this plan as opposed to a SEP IRA, due to the fact that you can make contributions of the employee and the employer. And the employee contributions can even be a Roth deferral. So if you've heard people talk about the Roth 401k, that's something that we have too. And there's some other benefits to the individual K that I'll touch on in a second here. Kind of moving in the side direction here, traditional versus Roth IRA. I touched about the Roth and the 401k. So what are the big differences between a traditional and Roth IRA? Well, a traditional IRA, generally you make the contributions to it, you're being able to deduct that from your taxes. It's pre-tax. Or if it's coming out of an old qualified plan, when they take the money out of your pay, it's coming out pre-tax. So you're not being taxed on it. So it's called tax deferred. So you're not having to pay taxes on any earnings or anything that while you're still in it. But when you take those funds out at retirement, you're going to get taxed on that as earned income at that time. So that's what's considered tax deferred growth. In a traditional IRA as well, when you reach age 70 and a half, the IRS says, all right, no more contributions to this plan, and you actually are forced to start taking what's called required minimum distributions. So the difference with the Roth IRA, which came about a little bit later, is it's tax-free, because when you make the contributions to it, you've already paid taxes on that money. So if you're a new person starting out and you want to create a Roth IRA, you can make your contribution to that plan, and that's going to grow tax-free. So you've already paid taxes on it. So all that growth, when you reach retirement age, you're going to be able to pull that out tax-free. If you're still working past 70 and a half and making money, you can still contribute to this plan, and you're not forced to start taking distributions. So there's a lot of flexibility there. People that have traditional IRAs or other pre-tax retirement instruments can convert those funds to a Roth IRA. You just have to be prepared to pay taxes on the dollar amount you convert. And again, if anybody has questions on this, please feel free to go in the chat box, and I will answer those questions for you. Talk briefly about the self-directed 401k. We call it the 1K here. It's a little bit different than the IRA, as it falls under Section 401 of the plan. Again, like I said, this is only for these folks that are self-employed with no employees, and it works a little bit different. So instead of the IRA needing, like an IRA needs a custodian, which is the role that we play. We're an IRA custodian, so that allows you to make investments with your IRA. Well, the solo 401k is what's called a self-trusteed plan. And not to be confused with trust deed, trusteed plan means that you are essentially the custodian of your own plan. So that allows you to directly make investments from your 401k plan to an investment. Or what a lot of people do is they set up a third-party company to then make the investment. So we also have this plan. There's some other big benefits is you can loan yourself money from the plan, which is something you cannot do with an IRA. So just like a company 401k, you can actually loan yourself up to $50,000, and then you're paying back your own retirement plan. So it's a great tool here, and it's something that we have and allow you to invest in real estate as well. So it's pretty simple. Either if you have a corporation, you want to create a new one, or even if you're a sole proprietor, you create the 401k. If you have any pre-tax retirement funds, you can roll those over in there, start investing, and start making contributions as well. So again, it allows you to purchase real estate. You can loan yourself money. You can use it to help start a business and do all sorts of investments. The IRA is what most people are getting into, though. They have an old 401k or other qualified plan. They roll that over into an IRA. If it's already an IRA, they transfer it over, direct us to fund the investment, and then the assets in their account with us. We have about a 24 to 48-hour turnaround time on moving people's funds to the investment. The longest part of this process is moving the money from their existing retirement plan over to us. I'd say on average it takes about 2 weeks, but it can take anywhere. It really depends on how liquid your funds are and what custodian it's with. Different custodians follow different timeline processes. So again, your IRA can hold all types of investments, real estate being one of them. I'm real excited to turn it over to Jillian here in a second to talk about Realty Mogul and the options that we have with them. My contact information is here. And give me a second. I'm going to turn it over to Jillian. Jillian, are you there?
I'm here.
All right. Well, I hope that was helpful for you. And again, everybody, please feel free to put any questions you have for Jillian and I into the chat box there. All right. I see your screen there, Jillian, and let me know if you have any questions. I'll be here.
Wonderful. Thanks, Brian, and thanks everybody on the webinar for having me today. I'm excited to talk a little bit about crowdfunding, and more specifically, I want to address using crowdfunding to generate passive cash flow from real estate in your self-directed IRA. So I'm going to start with the requisite disclosures. I am not an attorney or a CPA. What I am and how I come to you today is a real estate investor, a certified wealth strategist, a Series 63 holder, and a business owner. I personally am a passive cash flow investor. I like to see cash coming off of my investments, and it's even better when they are in a tax specialized account like a self-directed IRA. So before we go any further, let's talk a little bit about what is crowdfunding. Some of you may be familiar with the term due to the passage of the Jobs Act in April of 2012. So we're still waiting for final regulations. But for those of you who don't know what crowdfunding is, at its core, crowdfunding means pooling money together from a group of investors to make an investment. In this sense, crowdfunding has existed in real estate for centuries. Neighbors have bought property together, husbands and wives and their sisters and brothers have collectively bought property, and even multiple institutions have come together to collectively purchase property. In the past, this used to be called syndication. And there's some major differences between collective real estate investing of the past and crowdfunding for real estate today. So I'm going to walk through the top 5. The number one is the ability to transact online. Historically, you had to have, access to a network. You were faxing. You were, using snail mail. There's now the ability with today's technology to do the entire process online from the comfort of your own home. The number 2 is unparalleled access to deal flow. Historically, to find real estate investments, you really had to know all of the players. Typically, it was someone in your network, or your brother, or your aunt, or your uncle, maybe a friend of yours, and you had access to their select deal flow. Maybe it was in one geography, for example, in San Diego. But you may have not had access to transactions in other markets, like Washington, or Texas, or Oklahoma, or Florida. Primarily with the cap rate compression here in the California markets, where it's a little bit more difficult to get cash flow from your real estate investments, it's really, really great to be able to diversify on a geographic basis. And crowdfunding gives you that ability. Number 3 is lower minimum investments. Could be $5,000 or $10,000 compared to a $50,000 or $100,000 investment historically. And this really gives you the ability to diversify across a wider range of investments. Number 4 is 24/7 access to reporting and money management. Because it's online, you don't necessarily need someone to pick up the phone to give you access to your latest reporting or tell you how much you have an account or what you can expect for your next distribution payment. It's all housed online, and you have access, whenever you want it. The last one, and I think this one is, quite frankly, the most important, and is part of the reason why I am running Realty Mogul and why we launched Realty Mogul, is transparency. The ability for you to know as much information as possible about the investments that you're making, and the ability for you to share in those investments with other individuals in your network, whether it's your friends and your family or your colleagues who are collectively doing diligence on the real estate opportunities together, and giving you the ability to have even more transparency into the exact transaction. Those are really the 5 big differences from our perspective between the past and today and the future. So who are we, and why am I talking to you today? RealtyMogul.com is leading the crowdfunding revolution in real estate. And we're a marketplace for investors to pool money online and buy shares of pre-vetted real estate investments. And the reason that we started Realty Mogul is because I've had, numbers of real estate investments in the past where I've served as a landlord and we've bought our own properties as a family. And one of the biggest problems with it, and in addition to being just a huge time suck, is the reality behind having to deal with tenants, toilets, and trash. And I showed these images just to have them evoke some emotion and some feeling, and to share that at Realty Mogul, we are entirely passive cash flow investors. And we provide that service to our investors so they never have to deal, with a guy like this plunging one of your toilets. So what is passive cash flow? At its core, earning passive income means that you separate how do you make money from your time. So here's an example of a woman punching a time clock. And passive income is much different than active income, like showing up for work every day where your time and income are linked. As a passive investor, you can literally make money while you sleep. You have a steady stream of payments coming back into your accounts automatically, either every month or every quarter, with very little effort. Now, the majority of the time and the effort is spent up front, conducting due diligence on the investment opportunities and making the decision to invest to make sure that you understand all of the risks. Now, let's take an example of a savings account. A savings account provides you with recurring passive cash flow, but earning, 1% or less than 1% isn't exactly making you a whole lot of money. At least we're getting closer, though. You've now got some cash flow, and you don't have a second job. And you've technically got cash flow day or night, meaning you're earning interest day or night, irrespective of if you're awake or if you're working. But it ain't much, and that's really where real estate comes in. Real estate has proven to be one of the most effective vehicles for reoccurring passive cash flow. And I want to talk today about 2 different types of ways to generate passive cash flow from real estate. The first type is when you generate cash flow as income from rents. And when a property goes up in value, you also share in the appreciation. The second way is to loan money to a real estate company and to have that loan be secured by real estate, where you're getting monthly interest payments. So let's walk through those directly. In this example, maybe you're investing in an office building like this one, or in a multifamily apartment complex like this one. In either case, you're investing as a passive investor. And using crowdfunding, you don't own 100% of the building. You're going to own a piece of the building, like the left-hand corner in this image. So you don't have to invest, hundreds of thousands of dollars to own a piece of this building. You can go in with other investors and own a fraction of the building. So what are the risks and benefits of owning a piece of a building? You know me to be conservative and big on disclaimers, so let's start with the risks. The biggest risks to your cash flow are that expenses exceed income. For example, maybe the estimated vacancy is 10%, and at 10% the building cash flow is great. If in reality the building experiences maybe 50% vacancy, so half of the property doesn't have tenants, that cash flow is going to take a deep hit. The other risk is a decline in value. So for example, if you buy the property at $3 million, and then when you go to sell the property, it's only worth $2 million, there's obviously a loss in that transaction. So those are the two biggest risks of buying a piece of the property. And what about the benefits? First off, you get a participated cash flow from rent and appreciation when the property is sold. If you're buying a piece of property that already has tenants, you might see your first check as early as 1 quarter after you invest in the property. There's also no management. If a toilet breaks, you're not getting a phone call in the middle of the night. Lastly, your cash owns a physical asset. It's not a stock that could have a lot of volatility, but an actual building you can see, touch, and feel. That's recurring passive cash flow. And if done right, it'll be much more significant than any savings account. Now I want to talk about the second type of passive investment that we can make. And these are frequently made out of self-directed IRAs. They are loans secured by real estate. Now some of you may have seen TV shows like Flip This House. But I don't want to talk about you becoming a rehabber or a flipper today, because that's a job, and we're not looking for a second job here. I want to talk about you working with a flipper or a professional real estate investor to generate passive cash flow. You do this by making loans, and quite literally, you become the bank. Investing in loans secured by real estate is commonly called first trust deed investing. It means that you, the investor, become a private money source, and you're loaning money to a borrower. Now this borrower might be a flipper, like the guys in Flip This House, or it might be a real estate investor who owns 20 or 30 or 40 homes. And he rents those homes out and generates cash flow for his own investment purposes. Now a bank's not going to make that loan because the bank typically doesn't make more than 4 loans. So if that real estate investor's got 20 or 30 properties, he needs to look to another source for that capital to purchase those new properties. And that's where you come in. So when you make the loan, you always want to be in a secured position. And the document that secures your interest is called a trust deed. These trust deeds are filed at the county recorder's office, demonstrating legal proof that your loan has been made on the property, and it's secured by the actual property. By recording the trust deed, you're giving public notice to any lenders or lien holders that you hold a debt on that property. You're also shifting yourself from the possibility that the property is sold without repayment of the loan. The loan is said to be in first position because there's no other loans that have claimed that property before you. Should something happen with the loan, like a default, you're in the best position to recover your investment. You also have title insurance to ensure that you are in first position. One of the most important factors when making loans by real estate out of your self-directed IRA is to make sure that you have an equity cushion. At Realty Mogul, for example, we never showcase a loan that is more than the purchase price of a property. We typically look at loans that are less than 80% of purchase price, and we prefer even those less than 70% of cost. That 80% or 70% is called the loan-to-value ratio. And it's one of the most important things when you're looking at transactions that you potentially want to do. So what are 4 benefits of first trust deed investing? The first one, and I'm really big on this one, is lower volatility. Unlike the stock market, investing in loans secured by real estate tends to be less volatile. If the loan's paying 8%, for example, you can expect to receive that 8%, assuming that the borrower continues to pay the loan. It's rare that you would get 6% or 10% or 12%. It tends to be very, very consistent. The other one is that it's secured by an asset, and an asset that you can feel and touch and see. When you invest in paper assets like a stock or a bond, there's no physical asset that you can actually see and touch. The third one is consistent cash flow. At Realty Mogul, we provide distributions on a monthly basis on all of our loan investments. Different people do it differently. It's typically called servicing a loan, and it just depends on how it's structured. But for us, it's monthly. The last one is diversification. Investing in trust deeds gives you exposure to real estate without dealing with the hassle of tenants, toilets, and trash. And our minimum investment, for example, is $5,000. So with $25,000, you can invest in 5 different trust deeds, giving you added diversification. To recap, we talked about making 2 different types of investments. One is investing in a piece of a property, like a multifamily building, where your returns are more variable and you get paid from cash flow from rent and appreciation. And the other is investing in loans, where your returns are more consistent and your investment is secured by the property. Now, before I go back to talking about crowdfunding, I do want to provide one note about self-directed IRAs and a little thing called UBIT. So I'm not a CPA or a tax professional, but there is something about crowdfunding your IRA that is important to know. For transactions that use leverage, like investing in a commercial property like an office building or a multifamily building, when there's also bank debt, meaning they're also getting a loan from the bank in order to utilize leverage to generate higher returns, it may trigger unrelated business income tax. And this would require the IRA to pay that tax on an annual basis. That tax should not be triggered if you're making loans secured by real estate out of your self-directed IRA. That tax should also not be triggered if there is no debt on the commercial property. So these are things to keep in mind. If you don't mind paying taxes on it, either transaction may be a good transaction. If you want to avoid paying taxes on it, then the loan transactions may be a better fit. But of course, it always depends on your personal situation. So one of the questions that we get a lot at Realty Mogul that I want to walk through is, a little bit about crowdfunding, a little bit about passive real estate investing, but how does crowdfunding really work and what do you actually own? So when you do crowdfunding, you're investing alongside a professional real estate investment company with a history and a track record. And you're purchasing shares of a limited liability company as a limited member. In turn, that LLC, of which you're an investor in, either owns a loan tied to a real property or a share of a specific investment property like a commercial building. One of the benefits of that LLC is that you have liability protection, shielding any personal assets from the investment. And you're investing in that LLC as a limited member. So what does it mean to be a limited member, and who's making decisions? Decisions in an LLC are governed by something called an operating agreement, and it usually consists of a managing member and limited members. The managing member makes all of the day-to-day decisions, and the limited members are passive investors. They make the decision to invest in the transaction. And then from there on, the managing member makes all the day-to-day decisions. The managing member will set out a business plan, and they can determine how much cash to distribute and when to sell the property. So how does crowdfunding work from an operational perspective? First, you're going to create an account with a crowdfunding company. Realty Mogul is one example of a crowdfunding company. Next, you're going to be able to browse different types of investments and select an investment that's interesting to you. Select an investment that meets your risk and return profile, and select an investment that you're comfortable with and you want to invest in. The third step is to select how you want to own that property or own that investment. And I included a screenshot here of our website where we have an option for self-directed IRA. So if you're interested in making an investment out of self-directed IRA, when you go to do the investment process, you would choose that selection. From there, we work with your self-directed IRA company. AccuPlan is an example of a company that we can work with in order to formalize the structure and to get the transaction done on your behalf. The last step is to sit back and relax and watch your monthly or quarterly payments and updates come in as an investor in the transaction. And I've also included here a screenshot of what our dashboards look like. So I mentioned earlier in the presentation how one of the benefits of crowdfunding for real estate is that you have online access and 24-hour access to reporting and money management. And this is what it looks like on our end from our technology side. We're going to always show you how much money you've earned with us. And we're also going to show you a breakdown of how you're diversified. So what type of properties are you in? Maybe you have some residential, some multifamily, and some office. What type of geographies are you in? Maybe it's just Los Angeles, or maybe it's 3 or 4 different geographies. And also, what type of deals have you invested in? Is it loan purchases? Is it equity purchases? In conclusion, I want to show the top 4 reasons for passive real estate investing with crowdfunding. The first one, no tenants, no toilets, no trash. I love it from my own personal experience. The second one is leveraging the smarts of other people. There's different types of real estate investors in our economy right now. There are individuals out there who are experts in multifamily. There are individuals who are experts in self-storage, mobile home parks, office buildings, retail strip malls, triple net. It's incredibly difficult for any single individual to be an expert in all of these different asset classes. Maybe a massive conglomerate can do it, like some of the big real estate companies, but for other real estate companies to be able to invest with the expert in an individual asset class. So to be investing with the expert in, retail shopping malls, for example. That's one really, really interesting thing that crowdfunding allows you to do. The next one, make money while you sleep. This isn't a job. We're not looking to give our investors, another job where they're linking their time and their income. Literally, you can generate passive cash flow after you've made the investment decision on a consistent basis. And finally, you can do it seamlessly from the comfort of your own home. It's the ease of being able to do it on your time, where you're most comfortable, when you can discuss it with your friends or your family or your colleagues or whoever's around you that you make investment decisions with, and the ability to share with other individuals who you use to make investment decisions, be it your accountant, your self-directed IRA company, your attorney, or any other individual. So I love passive real estate investing. I love cash flow investing. I love crowdfunding. It's why we started Realty Mogul. It's why we're so excited about it. And I'd be happy to take any questions. And I'm also happy if anybody wants to email me and doesn't want to share the question online today. Info@realtymogul.com will come to my team, and I'll make sure that you get a response, for any follow-up questions that you may have. At this point, I'm going to turn it back over to Brian or for any questions.
We can leave your screen up there for a little bit here if you'd like. That would be fine with me, Jillian. I got a first question here. Is from Ryan. Looks like it's for me. He says, is Fidelity a plan administrator that allows current 401k rollovers to be self-directed? And the answer to that is still maybe. It depends how the plan administrator is generally like your HR. There's a company that's involved, and they might use Fidelity to hold the 401k plan, but Fidelity is not the plan administrator. They're actually the ones that hold the plan. So you still need to talk to your HR people and ask them if that allows those in-service rollovers. But that's a great question. Here I got a question for you. Do you have to be an accredited investor to invest with Realty Mogul?
That's a great question, and the answer is today you do have to be an accredited investor. I didn't spend a whole lot of time talking about the Jobs Act regulations, but I can touch on it. So the Jobs Act. What's that?
I was just saying, please do.
Yeah, so the Jobs Act was first signed into law on April 5th of 2012. And that act mandated that the Securities and Exchange Commission, or the SEC, allow us to open up crowdfunding to all investors, accredited investors and non-accredited investors, by January of 2013. So our model was to open up, to any investor that wanted to do business with us. Well, the SEC has taken a little bit longer than expected, and they still haven't issued final rules. So we're unfortunately at the mercy of the government right now. We're focused with accredited investors right now, but we're looking forward to doing business with non-accredited investors as soon as those SEC legislation is finalized.
All right. So I see Ted has a question, but I can't figure out how to hit the question. Ted, if you can write your question into the chat box, I'll be able to present it here. But that's some good information, Jillian.
And I can share too, Brian, which may be helpful, kind of what the definition of an accredited investor is.
Yeah, what's that?
So an accredited investor is either by an individual basis or by a joint basis with a spouse. So on an individual basis, it means that you're making over $200,000 a year. On a joint with spouse basis, it means that you're making over $300,000 a year. The other exemption is that you have a net worth of over $1 million, excluding the value of your primary home.
Got it. All right. Still trying to figure out how to. I see that Ted has a question. I can't hit it. Let's see if I'll give him a second. So I know you kind of showed a little bit of the dashboard and everything like that. How does the investment process work? I mean, they go on their dashboard and there's going to be a list of investments, or do you email people once they sign up different types of investments?
Yeah, so we allow investors to browse investments directly online once they've got a user account with us. So they can go in and browse through all the different investments and learn more details about it. Where's the property located? What is the business plan for the property? What's the estimated term for the investment? Sort of all those details. And then in addition, we do a lot of email follow-up. So every time we have a new investment, we email our user base, assuming they want email. They can always opt out, of course. But we do email our user base, and we provide any updates as we get them on any specific properties.
Got it. Do you have any questions for me, Jillian, that maybe came up during my presentation?
The one thing that may be interesting for you to touch on as well, Brian, is what your guys' process is, for example, if they're going to invest in notes that are secured by real estate. What does the paperwork look like on your end, and what does the process look like for an individual investor?
So let's just go with the more common person there, the IRA holder, and not the 401k. The IRA holder will open up an IRA. There's a one-time setup fee of $50, and then a flat annual fee of $275 a year, regardless of how many assets are in their account. We have some small fees for wiring of $15, ingoing and outgoing, and the client gets 6 free transactions without a separate transaction fee. So a transaction would be buying an asset or selling an asset. So if a client wanted to invest in one asset with us, they open up an IRA. We work on rolling the funds over or transferring the funds over to the IRA with AccuPlan, and then going to direct it to invest in what looks like an LLC with Realty Mogul. And so the IRA will become a member, just as you were saying, Julian, a passive member of that LLC. The IRA custodian, which would be us, would sign off on behalf of the IRA, and the IRA would own that portion of that LLC in their IRA as opposed to owning a stock, bond, or mutual fund. So really you're looking at a $50 setup fee, $275 annual fee, so $325, and then a $15 wiring fee. So that's how it would look, and then every time payments were made back from Realty Mogul, they would come back into the IRA. The clients get updated on that and have 24/7 access to their account. Ted's question, I finally figured out how to get it up here. What are the fees associated with an investment with Realty Mogul?
Wonderful. So we do not charge any transaction fees to our clients. We show all of the investments net of fees. So for example, on a loan that is at 8%, we may have originated that loan at about 10% and taken a 2% servicing fee. It depends on the loan. Some loans we can do at higher volume, some loans we do at lower volume. So it's on a deal-by-deal basis right now. But on our loan transactions, we always show it net of fees. And I don't anticipate us having anything lower than 8%, though that's what we're shooting for currently.
Okay. And it looks like we got another question here. How do you select your investments?
Sure. We have various underwriting guidelines to select our investments. And for our loan investments, for example, we won't do anything over than 80% of purchase price. We typically won't do anything over 70% of cost. We're looking for transactions in infill locations, so not super rural locations. We like to see transactions in infill locations. And on the loans, because they're collateralized by the property, we really care most about the property. We stress test all of our loans. So how bad does it need to get, for an investor to lose money or for something to go wrong with the investment? And we have, parameters, sort of like a checklist that we check off when we're looking at those loans. The biggest one being, loan to value and protective equity.
All right. We've got another question here from Jim. He asked, how does the investment in the LLC work? Are there a limited number of limited partner shares? Would I own a percentage of the LLC?
Yes, you own a percentage of the LLC as a limited member. There is a limited number. We cap out at 100 investors in our LLC. So the way we're structured right now, there would never be more than 100 investors in a single transaction. And you choose the dollar amount that you want to be in the LLC. So for example, maybe it's $10,000 or $15,000. And our documents will spin back, how much of the LLC you own. Maybe it's 50% or 20%, depending on the total dollar volume in the LLC.
Great questions, guys. Does anybody have anything else right now? Oh, I'm not seeing any hands up. Any maybe frequently asked questions that you usually get that we might not have covered here, Jillian?
You know, one that we get pretty often is how is it different than a REIT or a real estate investment trust?
Yeah.
And a REIT, you know, is investing in a stock. So similarly to investing in, you know, Google stock or Apple stock, you could also invest in a REIT, which is a real estate investment trust. There's different kinds of REITs, but the most common one is where they're buying up, you know, a bunch of commercial property, and then you own shares of a bunch of commercial properties. The big difference is that we give you more control and more transparency. A lot of times REITs are blind funds. I mean, you don't actually know what properties you're investing in. And the REIT has a lot of control to go buy, you know, a lot of different types of properties. With us, you can pick the exact property that you're investing in. So you can pick something close to your home if you want, or near your work, or you can pick something in a state, you know, where you don't have access to real estate. You have full control on what you want to decide. And that's an interesting thing, because a lot of times in a self-directed IRA, you know, the custodian will have control to invest those funds on your behalf, but you can actually pick exactly what you want to invest in. The other big difference is that we allow you to be very specific on a geography. So because REITs are so big, they may have to have a bunch of investments across a bunch of different geographies. You know, it's going to be very difficult to find a REIT that invests only in Los Angeles. But maybe you only want to invest in a very specific place, in Seattle, Washington, or Los Angeles, California, or San Diego, for example. We allow you to do that and sort of build your own REIT based around your own parameters and based around what kind of real estate you want to be investing in. So that's a question that we get pretty frequently.
That was a good one. You know, I should have thought of that one for you guys. But, well, I'm not seeing any other hands raised at this time. If anybody has any questions for Jillian, her contact information is right here. And hopefully this is being recorded. I'm trying to record it. We'll see how successful I am at it, and if it is, I'll email it out to all the attendees and maybe try to put it up on social media. So if anybody has any more questions, let me know. I'll show everybody my contact information again, and I think get that up there right there. You can reach me at Brian Davis at accuplan.net, probably easiest, or call me on my cell phone, 619-892-2438. Jillian, I want to thank you for being on tonight, and anybody that has any questions, feel free to reach out to Jillian or myself.
Thanks for having me tonight, Brian, and I second that. If anyone has questions, we're at info@realtymobile.com, and we're happy to have people call us and email us, and it was fun.
Thank you. Look forward to working with you guys further.
Great.
Have a great
Take
evening.
care.
Bye.